Thanks again, once again, for attending the December Festival of Traders. I have a great presentation for you today because I'm going to introduce these 4 steps that you can actually apply to virtually any market, any time frame. It makes no difference what strategy you're trading. It doesn't have to be a strategy that I teach. It could be something that you've developed yourself or you got from another educator. But I truly believe once you apply these 4 steps to your trading, you will increase your odds for consistency tremendously. You'll see exactly what I mean here. For example, let's take a quick look at this chart, Adobe here. Get used to this chart because we're going to be using this in the initial stages to actually exemplify what I mean here. But let's say you're interested in this, but you're not really familiar with the stock and you're not sure which direction it's going for all intents and purposes. Maybe you think it's in a downtrend. You're going to wait and see what to do because if it's in a downtrend, you don't want to buy anything yet. Maybe it's going to go lower, make new lows. Perhaps that guy on TV said, stay away from it because it looks like it's going lower. But with the 4 steps I'm going to be teaching you today, you would have known we were not in a downtrend at all. And in fact, we were actually in an uptrend. And therefore, the next step would have told you you could have possibly purchased right here. You would have known where to place your stop and ultimately where to place your exit point with a profit. And as you can see in the following days, you could have potentially captured 22.5 points, all by simply applying these 4 steps. So this is what we're going to be talking about today, 4 steps to trading consistency that once again you can apply to any market, any time frame. It doesn't matter what strategy or what technique you're using. I truly believe it will increase your odds for consistency tremendously. Now, everything you're seeing today is coming displayed from the platform I developed with Pro Trader Strategies. It's the PTS Primo charting platform. I designed this to make trading simple and to actually teach traders how to trade. And these 4 steps are auto-generated on the platform itself for ease of trading. So welcome once again. My name is Stephen Primo. I am the president and founder of Specialist Trading. I've been trading now for 48 years. In fact, in about a little over a month, I'll be trading now for 49 years. I can hardly believe it. I started my trading career on the floor of the Pacific Stock Exchange. I was on the trading floor for a total of 16 years, and 9 of those years I was a specialist. That's where we get the name Specialist Trading. If you're not familiar with what a specialist is, it doesn't mean you're any more special than anyone else. But in the old days, if you wanted to buy or sell a stock, you would call up your stockbroker. The stockbroker would put you on hold, take your order, let's say to buy 100 shares of IBM. He in turn would call the floor broker for that company and say, can you please purchase me 100 shares of IBM for my customer? The floor broker would put the broker on hold, walk over to the trader who specialized in making a market in IBM. In fact, this was one of the stocks I made a market in, which was IBM. And he would buy or sell that 100 shares and then report it back to the broker. This is the way the transaction worked in the old days. I know it's kind of antiquated, but before the advent of electronic trading and high-speed computers, this is the way trading used to be. So I traded that way during the crash of '87. I was on the floor during the crash and the bull market that followed. I left the floor in the mid-90s to manage money, also to trade my own account. And roughly about 15 years ago, I teamed up with Pro Trader Strategies with one goal in mind, and that was simply to educate traders around the world, all the things I've accumulated and learned in my nearly 5 decades of trading. So that's where we get Specialist Trading. And you'll see that attention to detail and really trying to educate you in today's educational class. Now, before we begin, we're required to share this with you, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results by applying these 4 steps, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. And since Specialist Trading is first and foremost an educational company, all examples are strictly for educational purposes only. Now, another way to get more education on a daily basis is to follow us on X, formerly known as Twitter. There's our handle right there. You may want to copy that down at SPCLSTTRADG, abbreviation for Specialist Trading. Every day I post anywhere between 5 and 7 different snapshots of signals our methods have generated and lots of free education, also little bits of financial wisdom. So there's lots of great free education on a daily basis. So please feel free to follow us on X. Now, I'd like to start out with something that my mentors taught me, because when I first started out trading roughly 49 years ago, I was on the floor and I had access to high-speed equipment at the time, computers there weren't any personal computers at the time, and advanced knowledge of some events that would have happened or some news events before the public. But still, in my first year or so, I couldn't make a dime. I struggled tremendously. I was just barely breaking even, and I didn't know how much longer I was going to be on the floor. And this is what my mentors shared with me, and it turned my trading around. They said, Steve, trading is really simple. It's the trader who makes it more difficult than it has to be. So think of it. Are you overcomplicating your own trading? Do you have 20 or 30 indicators on your screen right now? Do you have multiple monitors in front of you? Are you watching the TV as while you're listening to this, as well as reading the blogs and listening to all these so-called gurus? Are you involved in 2, 3, 5 different trading rooms or chat rooms? This is what overcomplication means, and it's really what stands in the way. I know I thought the same thing. I thought the more information and the more access you have to all this information, the easier and the more successful you will be at being a trader. But actually, the thing I've learned is the opposite. It's this overcomplication that stands in your way to success. And it's the simple things that actually have a clearer road to consistency than the overcomplicated ones. So once again, trading is really simple. You'll see that in today's class. In fact, these 4 steps, you'll say to yourself, it can't be this simple. I mean, how can trading be this simple and be successful? But really it is. It's the trader who makes it more difficult than it has to be. So once I started stripping away all these indicators, all these so-called trading gurus I had subscriptions to and newsletters to, and all this fundamental news I was listening to, earnings reports and economic news, once I forgot about it and just focused on the chart in front of me, that's when my trading turned around. And I truly believe that's what sustained me now for going on for nearly 5 decades. And hopefully it will be able to do the same for you. Okay, so in order to be consistent, you must always ask yourself these 4 questions. And this is prior to even entering into the trade. These are the different steps. So question number 1, am I on the right side of the market? Now, I know everyone goes into a trade believing they're already on the right side of the market, and every system, every technique, every trader has their idea of what it means to be in sync with the market. In other words, when you're on the right side of the market, you're in sync with the market. You're doing what the market wants to do. But think of it. If all traders have their means and their different ways in which to be on the right side of the market, why is it estimated that upwards of 80 to 85% of all traders fail? Well, that's obviously because they aren't on the right side. In other words, they're buying when the market wants to go lower, and they're selling, meaning going short, when the market wants to go higher. So the most important thing is to be in sync with the overall trend. So how do we do that? Well, let's look at our old friend Adobe once again. And remember, let's say you had just initially looked at this, you had no idea which direction it was going, up, back down, then back up again. But here's what we tell our students. It doesn't matter. We have students that have been trading for 30 minutes. We also have students that have been trading for 30 years that are hedge fund managers. And we teach them the same things. And here's the first thing. Before you pull the trigger, before you trade any method or strategy, you must apply the 50-period moving average. And then once you've applied it, ask yourself, where is price in relation to the 50-period moving average? Okay, now obviously price is above here. So if price is above, that is telling you, the market is telling you the overall trend is up. And that's how you are in sync with the market. That's how you're wanting what the market wants. You will only be in sync with the overall trend. And if it's up as it is here, you will only look for buy signals. Okay? Doesn't have to be one of my strategies or one of my techniques. It could be one of yours, but at this point, you are only looking at this chart with a buyer's perspective. All right, so you say to yourself, okay, well, Steve, I'm a candlestick trader. I'm a candlestick student. I like to look at the candlestick patterns. So that's fine, as long as it's a bullish pattern. And what do we have here? We have a bullish engulfing pattern. So let's say you decide to trade off this pattern, which is in line with the 50-period moving average, and you say to yourself, I'll buy once it trades just above that second bar in the pattern. Okay, fair enough. That's a good enough plan in order to initiate. But now this leads us to question number 2, which is, where do I place my initial stop? Now, most traders, especially the beginners that come to our courses, say, well, don't I have to first think about where am I going to get out with a profit? No, you first have to think, where am I going to get out with a loss? Because this is what traders don't do. They figure out how to get into the trade. And then when we ask them, well, where are you going to get out if it doesn't work? They say, well, I'll decide that when I get to that point. I'll cross that bridge when I get there. But that's really wrong, because then emotions come into play. Then you watch it go lower and lower or against you. And then what turned out, or what was supposed to be just a short-term play, turns out to be a long-term investment now, because now you're holding on. Had you had a stop placement, knowing that where you get out if you were wrong, well, you could have easily exited and gone out with a smaller loss. So let's use one of our simplest and most powerful ways in which to place your stop. Now, in our courses, we have upwards of 6 or 7 different ways to place a stop. Some traders like large risk because they have a large account. Others traders don't like large risk. They want the minimal risk allotted, so we will give them that. And there's still different ways to place stops. So we're going to use probably the most generic, just to share with you today, and the most probably the simplest way to identify a stop is by using the previous low. So the way that would work is, if you were to buy here or somewhere around here, once it went above, go backwards and look at where the most previous low was. And this is what we call a pivot low, because it has kind of a pivot or a kind of a V shape here. As you see, you have a low followed by a lowest low and then the higher low. So it creates this kind of a V approach. That's the most recent pivot low. So we would place our stop just below there if it traded below that lowest low, okay? So that's our stop placement. And remember, we haven't even gotten into the trade yet. We already know where to enter. We know where to place our stop, which now will lead us to question number 3. And that is, what is my profit target? Now we can decide where we're going to be getting out with a profit, because we've determined where we're getting out with a loss, and this will help us define the profit. Let me share with you what I mean here. Okay, if we were to enter at this point right here, and then for some reason it just turned around and price went much lower, how many points would you lose? Not how much money, because everyone has a different amount of an investment. How many points would you lose? And in this case, that would have been 11.25 points. Now remember, we haven't even gotten into the trade yet. But at this point, you can tell yourself, well, am I willing to risk 11.25 points? Do I have a big enough account size? Or does that meet my risk parameters emotionally? Will I be able to sleep at night if I lost 11.25? And if it meets your requirements, if you say to yourself, yeah, that's okay, I could risk 11.25 points with how much money I have or how much emotional I would feel. Well, then what you want to do is double that amount. You want to make twice that amount. This is called risk-reward ratio. You're risking 11.25 points to make double that amount, which would be 22.5 points. So you would double that point amount and simply add it to where you entered, and this will tell you where you exit. Now, this is a very simple, very basic way in which to exit. We have other 6 or 7 different ways to exit. I'm just sharing with you the most basic. But this, once again, is showing you how simple trading can be. So once again, we haven't entered into the trade. We know where we're going to get in. We know where we're getting out with a loss, and we know where we're getting out with a profit. And we go to the 4th and final question, which is, how do I protect my profits? Now, this is probably the most important step of the 4 questions, because how many of you had at one time or another had a great trade where you have a really nice profit or a gain on paper? You haven't exited yet. And then something happens, maybe you walk away for a couple of days or you aren't following it. Then you look later on and what was a nice profit is now a loss. Maybe it's a major loss. This is probably the worst feeling in the world that a trader can experience, because you know that at one time you had a nice profit and it whittled away, you didn't do anything about it, and now you have a major loss on your hands. So what you always want to do is protect that profit, even if it's just a paper profit. But how do we do that? Well, we teach our students what we call the 50% rule. And what that means is, if we were to enter here, and if we were to exit here, when price gets half the distance to our exit level, that's the 50% level. If price gets anywhere near that, it can get a little before it, it can touch it, or a little past it, well, then we will move this stop to unchanged. So what that means is, if we got up to this level and then all of a sudden price decides to reverse, at least we didn't lose any money. At least we broke even, okay? This is just a very basic way to protect your profit. And let me share with you how this could work out. So let's watch the trade unfold, okay? Well, we haven't entered yet because it didn't trade above that second bar of the engulfing pattern, but now it did. So now we're long. We have our stop in place, we have our exit, and we know where our protection is if we get up roughly around this area. So let's just watch the trade. There's really nothing you have to do, but simply watch. And ultimately, we got up to that 50% level. So this now means that we will cancel this stop and move our stop to where we entered. So now we're playing with house money. We have nothing to risk. We can sit back and watch. This is where trading gets simple, because now the only thing left to do is watch the trade unfold. You see, if you're there screaming and yelling and having two phones in both hands and the TV's blaring and you've got, you're reading some blog and you have multiple indicators, once again, it's getting back to what we started. You're overcomplicating your trading. But once you have these 4 steps in place, trading is simple. It's kind of like fishing. All you have to do is simply, you're on the boat, simply cast your line and wait. That's the way trading really is meant to be. If trading is really done correctly, if you're trading properly like a professional, it's very boring. It's extremely boring. You're just sitting back and waiting because all your orders are in place and there's nothing left to do. It's only the unprofessionals that are very intense, that are screaming back and forth, that have too many trades going on. That's not the way a professional trader trades. A professional trader, if he's doing it correctly, has a very boring job of just sitting back and watching. So let's watch the trade unfold. There's nothing left to do. It's going in our direction, but now it stops and starts to go the opposite direction. That's okay, but it's firming up again, and ultimately, days later, we hit the 22.5 point profit. That's it. That's how simple. Now, do you notice I didn't look at any fundamentals? I didn't look at what was going on economically or wonder what was going on with the earnings of this company or what the direction was. I didn't worry about overbought, oversold. I didn't worry about moving average crossovers. Remember, keep your trading simple and you'll get on that road to consistency much quicker than overcomplicating things. Let's take another look, another example, okay? Let's say you're not a candlestick trader, you're more of a technical analyst, and you like to look at chart patterns and lines and graphs and stuff, okay? And you see this pattern here in FSLR, and you say, this is a very bullish pattern, this is a bullish wedge. And the way this works is, if price breaks out above this wedge and closes above, this is a very bullish sign that most likely it's going to make higher highs, break out to new highs. So you're excited, you're waiting to see what it does, and the very next day, guess what? It closes above there. So what do? You jump right in and buy on the close, and you're all excited, you can't wait, you think you're going to make a ton of money. You were taught this in Technical Analysis 101, so you're sitting back and you're ready to count all your money, right? Wrong, because what is the first rule? What is the first step? Ask yourself this question: am I on the right side of the market? It's not just enough to know technical analysis. You have to listen to what the market is telling you. Is it telling you it wants to go up, or is it telling you it wants to go down? And the easiest and simplest and most powerful way to do that is to add the 50-period moving average. Now ask yourself, where is price currently in relation to that 50-period simple moving average? Well, initially it crossed over and it was above, but now we have 1, 2, 3, 4, 5, 6, 7 closes below. That is more than enough to tell us that the overall trend is not up, the overall trend is down. So therefore, why would we be buying? Okay, the odds are against you that this buy signal will work out. Why? Because you're swimming upstream. You're out of sync with the market. You're not in sync with what the market wants to do. The market is telling you, not me, not some guy on TV, the market is telling you, I want to go lower. But for some reason, you're buying. So we don't want to be a buyer, all right? All right, so you say to yourself, okay, wow, I dodged that bullet. Okay, but I'm still a technician, so what am I looking for? Well, maybe you see a ledge here. And aren't you glad that you didn't buy? Because most likely you would have been stopped out. But perhaps you see this little kind of support, this mini ledge here, and you say to yourself, all right, if we break this little support, then I'm going to be a seller, okay? So Okay, that's a good enough plan. You're in sync with the overall trend of the market by applying rule number 1. Now let's go to question number 2. Where do I place my initial stop? And we're going to use, once again, the most basic, which in this case would be the most recent short-term high. Remember, we teach 6 or 7 different stop placements. We're just trying to keep things simple here. So what you do is, if we were to go short here, maybe buy the puts, whatever trading vehicle you want to apply, but if we were to sell short here, going back in time, what would be the most recent high? And it would most likely be here, okay? You have a high, followed by a higher high, and then a lower high. So this is the most recent pivot high, and this would be a place to place your stop. Very logical, very basic. Now we go to question 3, which is, what is my profit target? All right, so we use the same principle we used before. If we were to go short here, and for some reason it did turn around and price started to go back up, how many points would we lose? Not how much money, because everyone has a different amount of shares or everyone has a different vehicle of trading. How many points would you use? Well, lose, excuse me. In this case, it's 8.20. Now you have to ask yourself, and this is even prior to getting into trade, could I afford to risk 8.20 points? Do I have a big enough account size, or can I sleep at night losing 8.20 points? If you decide realistically that, yeah, that's fine, I can risk that, that's not a big problem for me, great. Then what you want to do is double that amount, which would be 16.40 points, and then subtract it from where you would initially sell short. So 8.20 times 2 is 16.40, and you would subtract that 16.40 points, and this will give you your level in which to cover your short. And that would be at 51.15. Very simple. This is a very simple risk-reward ratio, very basic. You're making twice what you want to risk. This leads us to the 4th and final question, which is, how do I protect my profits? Remember, what if price starts to go down and you're all excited? Maybe you've got the puts or you've shorted the stock. Then all of a sudden it turns around and that nice profit you had on paper is given away now, completely disintegrated, and now you have a major loss. You always want to protect a profit. So we do this by applying the 50% rule. If we were to go short right here at 67.55, and if we were to cover our short right here, we want to basically know where the halfway point is, and that would be right here. So if price gets near here or a little below it, we are going to cancel this stop and move it to unchanged. Let's see what happened. Let's watch the trade unfold. Well, the very next day, we got short because it traded just below that ledge. And by the end of the day, we've got a small little profit, but now we've got a nice profit, okay? And it's getting close to that 50% level. And in 3 days, we got half the distance to our profit target. So obviously, we don't want to keep our stop here. We want to cancel this and move it to where we went short. Because now, if price all of a sudden decides to turn around and go back up, well, guess what? We didn't lose anything. And you can come back to trade another day. You see, that's what you've got to think about. Most traders don't think in terms of that. They always think, well, gosh, I'm going to make so much money on this. I can't lose. This is going to be a great trade. But you have to think in the back of your head, well, if I do lose though, I mean, how much am I risking? Can I come back to trade another day? Do I have enough money? Remember, the stats are 80 to 85% of all traders ultimately fail. And when I mean by failing, it doesn't mean that you have a bad week or a bad month. It literally means that 80 to 85% of all traders are giving away all that they've saved, their little trading nest egg. It's gone. So you don't want to be in that percentile. You want to protect what capital you have. So we've moved our stop to the entry price, so we can't lose anything. And so this brings us to the only thing left to do is to watch the trade unfold. Remember, trading, if you're doing it correctly, is boring. You have your entry in, you have your stop placement in, you have your exit for the profit, you've got to the 50% rule, you've moved your stop down, and you just watch, like fishing. So if you're really tense with trading, if you've got too many things to do, if you can't keep track, you're not trading like a professional. This is more akin to gambling, You ever seen someone gambling? How, you know, they're very intense and they get too emotional, excited. That's the way most traders trade. They trade with a gambling mentality. What we try to do at Specialist Trading is to teach you how to trade with a professional mentality. So let's watch the trade unfold. Okay, well, now you've got a really nice profit on paper, and it's getting close to that level. And in roughly about a week, you've exited with a 16.40 profit. You've made twice the amount of what you risked. So there you have it, the 4 steps to trading consistency. Now remember, you can apply these steps to virtually any market, any time frame. Doesn't have to be daily stocks, could be crypto, could be a 5-minute chart of E-mini futures, could be currency pairs on a 2-hour time frame, or could be a monthly chart of IBM. It makes no difference. And it doesn't have to be one of my strategies. It can be any strategy you like, any technique you like. I truly believe these 4 steps to trading consistency will really improve your odds for success. And if you don't believe me, let's just take step number 1 by applying the 50-period moving average. I would venture to say, if you go back and look at your last 10 or 20 trades, I can almost guarantee that your losses were because you were out of sync with that simple first step. You were, in other words, buying, going long below the 50-period moving average, and you were selling or going short above. Now, by selling, we don't mean exiting a trade. No, we mean going short, betting for the market, whatever you're trading, to go down. Remember, you want to be in sync with whatever the market is doing. That's how you will get on that first step to consistency, because if the market wants to go up, that should be your only bias. You want to be a buyer too. And if the market wants to go down, that should be your only perspective. You want to be a seller. But the reason why most traders fail is because they're out of sync with that first simple step. Try it right now. There's nothing you need to purchase. There's nothing you need to buy or construct. Everyone has access to a 50-period simple moving average. Go back and look at your last 10 or 20 trades. I can almost guarantee that you lost because you were not applying that simple but powerful rule. Now, we have a great special offer for all of you attending today. We have a good crowd here today, and we realize that, you know, maybe some traders have been trading for a long time and they have access to these different consistency rules, but they've never really applied them and they'd like more edges. We also know that there are a lot of traders who've been trading for a relatively short time who need more experience, more edges as well. So because of that, we have a great promotion today. We're going to offer you what we call our Trading Floor Edges course. Now, this is a 10-video course. Think of it, 10 videos that you'll get, which include over 48 years of trading experience. Next month, it'll be 49 years. So these are things, once again, that I've accumulated, tips and techniques and methods that I've accumulated in my nearly 5 decades of trading that you won't really find anywhere else, because most of these things are from the trading floor, my days on the trading floor, the stock exchange. Many more high probability trading edges, such as 2 more techniques that can elevate your trading. How to be in sync with the overall trend. We just shared with you one way. We have a total of 4 different ways sharing with you how you can do that. Also, 3 steps to a successful trade, 3 more steps. How to fine tune your entries, next level exiting techniques. Remember, everything you teach in this course can be easily applied to virtually any market and any time frame. I know a lot of educators say, oh, we have a great strategy or a great system. And then when you purchase it, we say, well, it can only be applied to this certain market or this certain stock or this certain time frame. I would say, venture to say, 95% of the things we teach and promote at Specialist Trading can be applied to virtually any market and any time frame. There's no reason to buy 2 different sets of methods. Everything can be easily transferred if you like to trade different markets, different time frames. And I think one of the best things in this 10-video course is a superior candlestick trading edge. Okay. Now, it's been my experience that most traders have traded candlesticks at one time or another, but they're not seeing the type of results that were promised when they first started seeing them. Am I right? I mean, most of us thought, wow, these are going to be the savior of my trading, and all these different candlestick patterns are going to really get me in tune. But most traders don't see the results they want because, in my opinion, most candlestick patterns are faulty. But let me share with you what we've developed, a superior candlestick trading edge. For example, let's look at this older chart of PLTR. Now, the way most candlestick patterns work is they are reversal patterns, meaning that if you have a trend in this instance, it's going up. You're looking for a reversal candlestick pattern, meaning that that trend will come to an end, and you can either exit the position or use it to go and sync with the next trend. So as you see here, PLTR was in an uptrend, but what do we have here? We have a dark cloud cover pattern, which is very negative pattern, and then 3 or 4 bars later, we have a bearish engulfing pattern. So two very negative patterns, very close to one another at the top of this nice move in PLTR. So if you were long, most traders would say, well, gosh, it's time to sell, right? I'm gonna get out. And if you were more aggressive, you'd say, well, it's time to go short. So let's say you did both, you exited your position and you went short. So you're all excited, you're a big candlestick trader, you got two very bearish patterns, and then this happens, right? This is what we've seen, myself included, when I first started trading candlestick patterns roughly about 45 years ago. And there's just not a lot of consistency. So what we teach in the course that you'll be getting here in this 10 video course is that you wouldn't have sold here at all. In fact, with the superior candlestick pattern, you would have actually been buying the bar before and been able to take advantage of the next week's big upward move. So you'll learn all the rules and how to trade this superior candlestick trading edge, which is included in this 10 video course. Okay, so you're gonna get a lot more edges, more techniques, more tips that you won't find anywhere else, because most of this I've accumulated and taken from my trading days on the stock exchange floor. Now, this 10 video trading floor edges course on my sister site, Pro Trader Strategies, usually runs for close to $1,000 because it's 10 videos and it's jam-packed with that much information. But here's what we're gonna do. For a very limited time, and I mean really limited, we are drastically discounting this down to only $19. But this is for a limited time only. I mean, think of it, $19. Most likely, you can't even go out to breakfast for yourself less than $20. But if you wanted to take 2 people, it's going to be $35 to $50, right? But for $19, you are getting over 5 decades or close to 5 decades of edges that I've accumulated that you won't find anywhere else. And they're yours for life to keep. So this is a great way to become acquainted with us and to get more of these edges, very similar to what I taught you today, but different because they apply to different markets. Now, we're also going to throw in an extra bonus with our association with the Festival of Traders. We want to get to know you. So here's what we're going to do. Along with your purchase of the Trading Edges courses for $19, we will also include a 50% discount on any other product we sell. Any strategy, any indicator, any technique, or access to our platform, you will get 50% discount. So this is a phenomenal extra bonus along with nearly 5 decades of trading techniques at your fingertips. You owe it to yourself to take your trading to the next level. Come on board with this Trading Edge course for just the limited price of $19. Here's how to take advantage of this. Contact my sister site, which is Pro Trader Strategies. I would highly recommend giving them a call at this number right here, 310-598-6677. They have trading consultants manning the phones right now. They'd be more than happy to take your $19 order over the phone or answer any question you may have about any of the strategies or techniques we have, and about the 50% discount. They can help you with that as well. Now, that link you see at the very bottom is the link that will take you to the info page and sign up page if you'd like to sign up online. But it's not a live link. You have to copy and paste that. So I think Dave is going to be able to post this on the chat box or so. But you should have access to this later on. Remember, this is being recorded as well, so you'll be able to see this later on as well. But I would highly recommend giving Pro Trader Strategies a call. They're very flexible. They're there to work with you, and they'll answer any question that you may have. Now, I have a few more minutes to take any questions, a couple of minutes. So if you do have any, now is the time. Let me just see if there are any available. One thing I know that a lot of people ask is, what happens if I have a question? What happens in this 5 video course if something doesn't make sense to me or I'm not sure I'm doing it correctly? Well, one thing I didn't mention, with all of our courses, with all of our different promos and different specials, regardless of the price, you could be purchasing an expensive program of ours or something as little as $19. Every one of my students will get my private email address. This is not the email address you see here. This goes to Pro Trader Strategies, but you will get my private email address where you can email me a question, send me your work to see if I want to check it for you or not, or just examples so that you can answer any question you have. And you can basically email me whenever you like, prior to openings, after the close, during market hours, or even on the weekends. It makes absolutely no difference. You can always contact me, because once you're a student of mine, you're a student of mine for life. So we have that for you, because it's the next best thing to having me come and sit next to you. So don't worry if something you feel it's like, I'm not sure if I'm doing this correctly, how do I check? You can contact me whenever you'd like, and you'll get that with the $19 discount as well, okay? I don't see any other questions. Let me just see if there are any. Yeah, I don't see any other questions, so I guess everybody has this. I would suggest give that number a call. I think the next session is starting in a couple of minutes, so once again, I would just give them a call at 310-598-6677. And Dave, if you're there, I can give it back to you.